Gold and silver are screaming a bigger warning than the Fed, and almost nobody is listening. The central bankers are speaking. The markets are reacting. The headlines are screaming Fed rates. But gold and silver are not waiting for permission. They are moving quietly, deliberately, and with a precision that only appears once in a generation. The last time metals moved like this, everything that followed changed. Welcome back to Financial Crisis Explained, the channel where we do not follow the noise. We follow the evidence. Now, before we go any further, if you have been with this channel for some time, you already know what serious financial analysis looks like. But if you are new here, think of subscribing to this channel the same way you would take advice from a wise, experienced elder who has lived through recessions, market crashes, oil shocks, and currency collapses. You would not walk away mid-conversation. So hit that subscribe button and stay at the table. The information ahead is not for the casual viewer. It is for the serious one. And before we begin, where are you watching this from today? Drop your city, your country right there in the comments below. Because this warning we are about to unpack affects every economy on every continent without exception. Now let us begin. There is a particular kind of danger that does not announce itself loudly. It does not ring alarms. It does not break into headlines at midnight. It does not send emergency alerts to mobile phones. It moves quietly through balance sheets, through vault inventories, through the slow and deliberate accumulation of something ancient, something that has outlasted every empire that ever tried to replace it. And right now that danger is moving. Every major financial network in the world is pointed in one direction: the Federal Reserve. Analysts are dissecting every word from every press conference. Traders are building entire strategies around the timing of one rate decision. Portfolio managers are restructuring billion-dollar positions based on a single sentence from a single central banker in a single room in Washington. And while all of that attention is focused on one institution, gold and silver are quietly telling a completely different story. This is not the first time this has happened. In 2005, the majority of sophisticated investors were watching interest rate cycles, debating housing market sustainability, and positioning around Federal Reserve commentary. Gold was already moving. Not dramatically, not with fanfare, but with the kind of steady, purposeful momentum that only becomes obvious in retrospect when the people who missed it are left explaining why they were looking somewhere else. By 2008, the question was no longer whether a crisis was coming. The question was how deep it would go. The investors who had followed the metals were already positioned, already protected, already calm, while the rest of the financial world was trying to understand what had just happened to them. Here's the fundamental problem with Fed watching as a primary investment strategy. The Federal Reserve is a reactive institution. It does not predict economic conditions. It responds to them. By the time the Fed raises rates to fight inflation, inflation has already been eroding purchasing power for months. By the time the Fed cuts rates to stimulate growth, the economic slowdown has already begun compressing earnings and employment. The Fed is not a lighthouse warning ships away from rocks. The Fed is the Coast Guard, sent out after the ship has already made contact. Gold and silver do not wait for the Coast Guard. They respond to the rocks themselves. So what are the rocks right now? The first is inflation. Not the headline number that gets revised quarterly, not the carefully constructed index that excludes food and energy, because those categories are considered too volatile. The real inflation, the one measured in grocery bills, rent payments, insurance premiums, and the quiet, creeping realization that the same income buys meaningfully less than it did 24 months ago. When real inflation persists, when it refuses to be controlled by rate adjustments, gold and silver do not need a catalyst. They already have one. The second rock is debt. Global sovereign debt has reached levels that would have been considered theoretically impossible by economists 20 years ago. The United States alone is carrying a debt load that consumes an increasingly significant portion of its annual revenue simply in interest payments. Not principal reduction. Not infrastructure investment. Not economic stimulus. Just interest. When a government reaches the point where debt services itself at the expense of everything else, the currency that government issues begins to carry a question mark. And historically, without exception, every time a major currency has carried that question mark, real assets answered. The third rock is the one most investors are not discussing at all. It is not a policy decision. It is not an economic indicator. It is not something that will appear in a quarterly earnings report. It is a question. A quiet, fundamental, and increasingly urgent question that serious money, institutional money, sovereign money, generational money is beginning to ask out loud. What is actually safe? Not what generates the highest return in a stable environment. Not what performs best when everything is functioning normally. But what holds when nothing is functioning normally? That question is what gold and silver are responding to right now. And the answer they are providing is the warning most investors are not yet prepared to hear. What the metals market already knows: there is a moment in every major economic shift where the data is already speaking. The signals are already present. The evidence is already assembled. And yet the majority of investors are still debating whether anything is actually happening. That moment is not coming. It is already here. To understand what gold and silver are communicating right now, one must first understand something that financial television rarely explains clearly. Metals do not react to what is happening. They react to what is being priced in. There is a profound difference between those two statements. When a market reacts to what is happening, it is responding to confirmed data, published reports, official announcements, verified numbers. By that point, the opportunity has already moved. The early position has already been taken. The patient investor is already watching from a position of strength while the reactive investor is still reading the headline. When gold and silver move the way they are moving right now, they are not reacting to confirmed data. They are pricing in something that has not yet appeared in any official report, any central bank statement, or any mainstream financial forecast. And that distinction is everything. The first signal that demands serious attention is institutional accumulation, not retail buying, not the gold coin purchases that spike during moments of public fear, not the silver demand that trends on social media every time a financial influencer posts a chart. Institutional accumulation, the kind that happens in boardrooms, in sovereign wealth fund meetings, in the quiet corridors of central banks that are not the Federal Reserve. Since 2022, central bank gold purchases have reached levels not recorded since the early 1970s. That reference point is not arbitrary. The early 1970s was the precise moment the United States permanently severed the dollar from its gold convertibility, ending the Bretton Woods system and fundamentally altering the architecture of global monetary trust. The institutions accumulating gold today lived through that transition. They are not buying gold because they expect rates to fall. They are buying gold because they understand what happens to paper currency when the institutional trust that supports it begins to quietly fracture. The second signal is the paper to physical ratio. This is a metric that receives almost no mainstream coverage, and yet it may be the single most important structural indicator in the entire metals market right now. For every ounce of physical gold that exists in registered COMEX vaults available for delivery, there are dozens of paper claims. Futures contracts, ETF obligations, derivative positions, all referencing that same ounce. In a stable functioning market, this ratio is manageable. Most paper contracts never demand physical delivery. They are settled in cash. The system runs on the assumption that physical demand and paper supply will never collide at the same moment. But assumptions are not guarantees. When physical demand accelerates while paper supply remains stretched, the mathematics of that collision produce outcomes that no rate decision can prevent. History has demonstrated this pattern repeatedly, and the current ratio is not moving in a direction that should provide comfort to anyone paying close attention. The third signal is the behavior of Eastern central banks. China, India, Russia, Turkey, Poland. These are not economies on the periphery of global finance. These are economies representing billions of people, trillions in trade volume, and an increasingly deliberate strategy of reducing exposure to dollar-denominated reserve assets. They are not doing this loudly. They are not issuing press releases. They are not announcing a coordinated departure from the existing monetary order. They are simply buying gold, consistently, methodically, at a pace that has no modern precedent. When the institutions that hold the largest reserves of dollar-denominated assets in the world begin quietly converting those reserves into something that carries no counterparty risk, that is not a portfolio adjustment. That is a statement. Now here is where the inflation variable changes the entire equation. Most investors operate under a simple mental model. High inflation leads to rate hikes. Rate hikes strengthen the dollar. A stronger dollar pressures gold. That model worked in a different era, under different debt conditions, with different levels of sovereign obligation. But that model has a breaking point. The breaking point arrives when inflation proves structurally persistent, when rate hikes begin threatening debt serviceability, and when the central bank faces a choice between fighting inflation and preventing a sovereign debt crisis. That is not a theoretical scenario. Several major economies are already navigating that precise tension right now. Gold and silver are not waiting for economists to officially name it. They are already pricing in what comes next. The 7 signals are not isolated data points. They are connected pieces of a single coherent picture. A picture that suggests the metals market is not reacting to short-term rate speculation. It is responding to something far older, far deeper, and far more difficult to reverse than any policy decision any central bank has the authority to make. Signal 4 changes the conversation entirely. When paper positioning meets physical reality, every financial system in history has operated on one foundational assumption, that the promise and the delivery will never be tested at the same time. Banks operate on this assumption. Insurance companies operate on this assumption. Pension funds operate on this assumption. And the modern precious metals market, specifically the paper derivatives market that sits on top of physical gold and silver, operates on this assumption more aggressively than almost any other financial structure in existence today. The assumption is held for decades, but assumptions do not break gradually. They do not send warning letters. They do not file advance notice with regulatory bodies. They hold and they hold and they hold. And then one morning, the market opens, and the assumption is simply gone. And everything built on top of it recalculates simultaneously. That recalculation is what signal 4 is pointing toward. Signal 4 is open interest data. And to understand why it matters at this specific moment, one must first understand what open interest actually measures. Open interest represents the total number of outstanding contracts in a futures market that have not yet been settled. In a healthy, balanced market, open interest rises and falls in proportion to actual supply and demand dynamics. Contracts are opened. Contracts are closed. The ratio between buyers seeking physical delivery and sellers capable of providing it remains within manageable boundaries. What is happening in the gold and silver futures market right now does not reflect a healthy, balanced market. Open interest in silver futures has been climbing at a rate that is disproportionate to documented increases in physical supply. The spread between what the paper market is promising and what the physical market can actually deliver is widening. Not dramatically, not in a way that triggers automatic regulatory review, but consistently, measurably, and in a direction that has preceded significant market dislocations in previous cycles. The professionals who monitor this data daily are not panicking, but they are watching it with a level of attention that they reserve for situations where the architecture of a market is under quiet structural stress. Signal 5 is the one that reframes everything that comes before it. It is not a number. It is not a ratio. It is not a data point that appears in any standard financial report. Signal 5 is the geographic migration of physical gold. Since early 2024, documented physical gold flows have been moving with unusual consistency from Western financial centers toward Eastern vaults. London, which operates the largest over-the-counter gold market in the world, has been experiencing withdrawal requests on allocated gold accounts at a pace that has created measurable delays in physical delivery timelines. This is not speculation. The delays themselves were acknowledged by market participants and reported in specialist financial publications. Allocated gold, which by legal definition belongs entirely to the account holder and should be immediately available, was taking weeks rather than days to access. When allocated gold, the gold that is supposed to be sitting in a vault with your name on it, requires weeks to physically retrieve, the market is communicating something that no press conference will ever say directly. The paper and the physical are not as aligned as the system requires them to be. Signal 6 brings the historical dimension into sharp focus. 3 specific moments in modern financial history created the conditions most comparable to the current environment: 2008, 2011, 2020. In each of those periods, gold and silver experienced significant volatility before delivering substantial directional moves. In each of those periods, the initial volatility was driven by paper market liquidation, margin calls, and short-term liquidity pressures. In each of those periods, investors who interpreted the volatility as a signal of metals weakness exited their positions. And in each of those periods, the investors who understood the structural backdrop held their positions and were ultimately validated by what followed. The current setup shares characteristics with all 3 of those periods, but it carries one additional variable that none of those 3 periods contained at the same magnitude. The sovereign debt load sitting underneath the current monetary system is categorically larger than anything present during any of those previous episodes. The fiscal space available to governments attempting to respond to the next crisis is measurably narrower, and the credibility of the institutional frameworks that managed those previous crises has been visibly, publicly, and significantly eroded. This time the foundation itself is different. Signal 7 requires no complex financial terminology to understand. It requires only honest observation. The central banks that spent decades telling their populations that gold was an outdated relic, an irrational hedge, a barbarous artifact of a monetary era that modern finance had permanently moved beyond, those same central banks are now the largest institutional buyers of gold on the planet. Observe that contradiction carefully, not the words. The behavior. When the institution responsible for managing a nation's monetary policy quietly accumulates the one asset that its own official position dismisses as irrelevant, that institution is not confused. It is not irrational. It is not acting on emotion or superstition. It is hedging against itself. It is acknowledging, through action rather than statement, that the system it administers carries risks that its public communications are not designed to disclose. Gold and silver do not need the Federal Reserve to rescue them. They do not need a rate cut announcement. They do not need a financial crisis to be officially declared. They need only one thing. They need the gap between what institutions say publicly and what institutions do privately to continue existing. And based on everything the data is currently showing, that gap is not closing. It is widening. What serious investors are doing right now? There is a particular kind of investor that does not appear in financial news coverage. They do not give interviews predicting price targets. They do not post portfolio updates on social media. They do not build their investment thesis around the next Federal Reserve meeting or the next inflation print or the next geopolitical headline that dominates the news cycle for 72 hours before being replaced by something else. They build their thesis around structure, around the architecture of risk that exists beneath the surface of daily market noise, around the question not of what will happen next week, but of what the current system is structurally capable of sustaining, and for how long. Those investors are repositioning right now, quietly, deliberately, and almost entirely outside the view of the financial media that is still debating Fed policy. To understand what serious capital is doing, one must first understand the concept of asymmetric opportunity. Asymmetric opportunity does not mean guaranteed return. It does not mean risk-free positioning. It means a situation where the potential upside of being correct significantly outweighs the potential downside of being wrong. Consider the current position of gold and silver through this specific lens. If the structural concerns outlined across the previous signals prove to be overstated, if inflation normalizes, if sovereign debt finds a manageable resolution, if Eastern central bank accumulation slows, and if the paper-to-physical ratio stabilizes without incident, then gold and silver may consolidate or experience moderate corrections from current levels. That is the downside scenario, moderate consolidation. Now consider the alternative. If even a portion of the structural stress currently present in the global monetary system reaches a point of visible dislocation, if the gap between paper positioning and physical reality becomes publicly apparent, if sovereign debt dynamics force a choice between inflation and default in any major economy, the historical precedent for what follows in precious metals pricing is not moderate. It is generational. The asymmetry of that risk-reward profile is precisely what serious institutional money is quietly responding to right now. For entrepreneurs and business owners specifically, this analysis carries implications that extend well beyond investment portfolio decisions. A monetary environment characterized by persistent inflation, structurally elevated debt, and diminishing institutional credibility does not only affect financial markets. It affects the operational reality of every business that prices products, manages payroll, services debt, holds cash reserves, or operates across multiple currency environments. The business owner who understands monetary transitions does not simply protect personal wealth. They structure their enterprise to function effectively within the transition itself. They price with awareness of purchasing power erosion. They manage cash holdings with an understanding of real versus nominal returns. They evaluate capital expenditure decisions against a backdrop that includes currency risk, not just market risk. The entrepreneurs who built lasting wealth during the inflationary periods of the 1970s were not the ones who predicted the exact peak of gold prices. They were the ones who understood early that the rules governing money were changing and who structured their decisions accordingly before the change became obvious to everyone. That window of early understanding is exactly what this moment represents. The most common mistake made by intelligent, capable investors during periods of monetary transition is waiting for confirmation, waiting for the official announcement, waiting for the mainstream consensus to shift, waiting for the moment when the structural warning becomes a visible crisis rather than an analytical conclusion. That instinct is understandable. Confirmation feels safer than early positioning. Acting on structural analysis before the crowd arrives feels presumptuous, even arrogant. The social and professional cost of being early and appearing wrong in the interim is real and should not be dismissed. But there is a cost to waiting for confirmation that is rarely discussed with equal honesty. By the time the structural warning becomes a confirmed crisis, the pricing of protective assets reflects the crisis. The asymmetric opportunity is closed. The gold that was quietly accumulating in Eastern vaults while Western analysts debated Fed policy is no longer available at the price that made the positioning intelligent. Confirmation and opportunity do not arrive together. They arrive in sequence. And the sequence is always the same. Opportunity first. Confirmation later. Significantly later. So what does a rational, evidence-based response to this environment actually look like? It does not look like panic. It does not look like liquidating conventional holdings and converting everything into physical metals based on worst-case scenario projections. It does not look like the kind of reactive repositioning that mirrors the emotional decision-making this analysis has been specifically designed to replace. It looks like a measured, structured acknowledgement that the monetary environment has shifted in ways that are not temporary, not cyclical, and not resolvable through conventional policy tools alone. It looks like evaluating the proportion of a portfolio allocated to assets that carry counterparty risk against the proportion allocated to assets that do not. Physical gold and silver carry no counterparty risk. They do not depend on an institution's promise, a government's solvency, or a central bank's credibility to maintain their fundamental value. In an environment where institutional credibility is visibly under structural pressure, that characteristic is not a minor portfolio consideration. It is a primary one. It looks like understanding that gold and silver are not making a statement about the end of the financial system. They are making a statement about the cost of ignoring structural risk in a period when structural risk is unusually elevated. The warning that gold and silver are currently communicating is not directed at pessimists or doomsday theorists. It is not a fringe position held by people who distrust modern finance on principle. It is a message being delivered by the behavior of the most sophisticated institutional actors in the global financial system. Central banks, sovereign wealth funds, generational family offices, the entities that have the most to lose from being wrong, and the most analytical resources available to ensure they are not. They are not watching the Federal Reserve for their primary signal. They are watching the metals. And right now, what the metals are saying is this: the system is not broken, but it is bending. And the investors who understand the difference between a system that is bending and a system that is stable are not waiting for the bend to become a break before they act. They are already positioned, they are already calm, and they are already watching.